Your Venmo account is sitting in a federal database right now. Not maybe. Not if certain conditions are met. Right now, today, the transaction history from your Venmo, your Cash App, your PayPal, your Zelle in certain circumstances, your Square, your Stripe, it is all ready with the Internal Revenue Service. And the reason most people don't know that is not because it's a secret. It's because the rollout has been slow, the deadline has been pushed, the news coverage has been confusing, and the overwhelming majority of Americans who are now inside this system have no idea they're in it or what being in it actually means for them. I want to be precise about something before we go a single sentence further, because this topic has been reported on sloppily, and the sloppy reporting has created two groups of people, both of whom are wrong in ways that will cost them money. The first group heard something about Venmo and taxes and panicked, and they're now convinced that every time a friend pays them back for dinner, they're going to get a tax bill. They won't. The second group heard that the deadline got delayed again and concluded the whole thing went away, and they don't need to think about it. It didn't. The rule exists. The reporting is happening. The IRS is receiving the data. And the gap between what people think this means and what it actually means is where the expensive mistakes live. So in the next 20 minutes or so, I'm going to tell you exactly what the IRS is seeing, exactly how they're seeing it, exactly what triggers a problem and what doesn't, what the 1099K form actually is, and what you're supposed to do when it arrives. And the three categories of people who need to pay close attention to this right now, because the consequences of getting it wrong range from an annoying letter to a very large bill with interest attached. And I'll give you the specific things to do this year before the next filing deadline to make sure you're not in any of those categories by accident. My name is Walter Thompson. I spent years in tax administration, and I've been making these videos because the space between what the tax code actually says and what ordinary people understand it to say is where an enormous amount of unnecessary money gets lost. I'm not selling anything, and I never will be. What I have is a clear picture of how this particular change works, who it affects, and what to do about it. So let's get into it. Start with the history, because the history explains why there's so much confusion. For years, the threshold for payment platforms to report your activity to the IRS was $20,000 in payments received, and more than 200 transactions in a calendar year. That threshold was set in 2008 as part of the Housing and Economic Recovery Act. The logic at the time was that the reporting requirement was meant to catch commercial sellers and business operators, not the casual user splitting a dinner check. So the threshold was set high enough that ordinary personal transactions wouldn't trigger it. Then came the American Rescue Plan Act of 2021, passed in March of that year, and buried in that legislation was a change to Section 6050W of the Internal Revenue Code that almost nobody outside of tax professional circles noticed at the time. The new threshold for 1099K reporting by payment platforms dropped to $600. $600 in aggregate per year. No transaction count requirement, just $600 received through the platform over the course of the year, and a form goes to the IRS with your name on it. Now, $600 in received payments on a payment app is nothing. That's selling an old couch and a bicycle on Facebook Marketplace, and getting paid through Venmo. That's 2 months of collecting your share of the household grocery bill from your roommates through Cash App. That's one freelance project, one tutoring session, one piece of furniture sold on Craigslist with payment through PayPal. For the first time in the history of this reporting requirement, ordinary Americans with no business, no intent to earn income, no self-employment in any meaningful sense are inside the system. The implementation has been delayed. I want to be direct about that because pretending otherwise would be dishonest. The IRS has pushed the effective date multiple times. For tax years 2022 and 2023, they granted transition relief, meaning the platforms were not required to issue 1099Ks under the new $600 threshold during those years. For 2024, the threshold was phased in at $5,000 as another transitional step. The full $600 threshold is where this is heading, and the direction of travel has not changed. The question has never been whether this is coming. The question has always been when, and the answer, based on everything currently in the regulatory pipeline, is soon. And for many people, it is already functionally here because the platforms have been reporting at various levels. Throughout the transition period, and the IRS has been receiving and holding that data, Here is the thing about data. The IRS receives and holds. They are very patient with it. The statute of limitations on tax assessments is generally 3 years from the date of filing, and 6 years if there's a substantial understatement of income. The IRS does not need to act on information the year it receives it. They can sit on it, cross-reference it against what you filed, pull your return from 2 years ago. Notice that a 1099K was issued for $8,400 in payments received and nothing. Corresponding to that appears anywhere on your return and send you a letter. A very polite letter to begin with. So let me explain what the 1099K actually is, because there is a fundamental misunderstanding about this form that is going to cause an enormous amount of unnecessary stress, and for some people, unnecessary tax bills. The 1099K reports gross payment volume received through the platform. That's the word I need you to focus on, gross. It is not a bill, it is not a tax assessment. It is not the IRS telling you that you owe money. It is the IRS saying, we know this amount of money moved through this platform into your account this year, and we'd like to see how you account for it on your return. The form itself does not know whether the money was income or not. It does not know whether you sold things at a profit or a loss. It does not know whether it was a gift or a reimbursement or a repayment of a personal loan. It just knows a dollar amount arrived. What happens next depends entirely on how you handle it. And this is the counterintuitive point at the center of this entire conversation, the one that matters most. The one I want you to really understand. Receiving a 1099K does not mean you owe taxes on the amount shown. What it means is that you have to account for it. You have to show the IRS why the number is what it is, and specifically, whether any of it is taxable income. For a very large number of people, the honest answer is that none of it is taxable, or only a portion of it is. But that answer has to appear on your tax return in a way the IRS can see and match to the form they received. If it doesn't appear, the IRS sees income on a 1099K, looks at your return, sees nothing that corresponds to it, and their computer generates a notice. Not because you did anything wrong, because the story your return tells doesn't match the story the platform told. Let me walk through the specific situations this affects, because they are not all the same and the tax treatment is different for each. The first situation is selling personal items secondhand. You sell a couch you paid $800 4 or 5 years ago for $200 on Facebook Marketplace. Payment through Venmo. You sell a pair of shoes you bought new for $150 for $40 on Poshmark. You sell a kitchen appliance, a set of golf clubs, a television, a camera. You bought these things for personal use. You used them, and you sold them for less than you paid. This is called selling at a loss on a personal use asset, and the rule here is clear. You do not owe tax on it. The gain on the sale of a personal use item is taxable. The loss is not deductible, but it's also not taxable income. If you sold a couch for $200, that cost you $800. There is no taxable event. Zero. The problem is, the 1099K doesn't know that. The platform reported $200 received. The IRS has $200 on file. Your return needs to show them what that $200 was. The way you do that is by reporting the sale on your Schedule 1, showing the proceeds, showing the original cost basis, which is what you paid for it, and showing that the result is zero gain or a loss. You're not paying tax. You're not claiming a deduction. You're simply reconciling the number the IRS received with the reality of what happened, which is that you sold something you owned for less than you paid for it, and there's nothing taxable in that transaction. The form is not the problem. Not accounting for the form is the problem. The second situation is getting reimbursed for personal expenses. Your friends pay you back for concert tickets you bought for the group. Your roommate pays their half of the electric bill through Cash App. Your family splits the vacation rental through Venmo and sends their shares to you. These are reimbursements. They are not income. The IRS has always understood that reimbursements are not taxable. The issue now is that if those reimbursements accumulate to more than $600 through a single platform, a 1099K may be generated. And a 1099K that represents personal reimbursements and not income still needs to be addressed on your return. Now, the platforms have tried to help with this. Venmo and Cash App both have a setting allowing you to mark transactions as personal rather than business. Using that feature consistently for personal transactions is the first line of defense. It doesn't guarantee you won't receive a 1099K, but it signals to the platform and creates a record that these transactions were personal in nature. If you are regularly collecting shared expenses from friends or family through any of these apps, go into the settings today and make sure you're marking those transactions correctly. It costs you nothing, and it may save you a very unpleasant conversation with your accountant in February. The third situation is casual freelancing and side income. And this is where the conversation changes, because this is where real taxable income is genuinely in play. And this is where I see the most dangerous combination of two things: real money that should be reported, and a person who didn't know they needed to report it because it felt too small or too informal to count. You do occasional graphic design work for a neighbor, and they pay you through PayPal. You walk dogs on weekends and collect through Venmo. You sell handmade items on Etsy. You do occasional photography, tutoring, bookkeeping, translation, copywriting, consulting, any skill exchanged for payment through a digital platform. All of that is self-employment income. It has always been self-employment income. The tax code has always required it to be reported. What changed is not the rule. What changed is that the IRS now has a direct data feed from the platform telling them the payment happened before the 1099K threshold dropped. A lot of this income was going unreported, not through any conscious decision, but simply because people didn't know they were supposed to report informal payments. The $20,000 and 200 transaction threshold meant most casual freelancers never received a form and never thought about it. Now they will receive a form, and the form will go to the IRS, and if the income doesn't appear on the return, the notice follows. Self-employment income under $400 in net profit in a year doesn't trigger the self-employment tax, but it is still technically gross income that should appear on the return. Over $400 in net profit, and both income tax and self-employment tax apply. Self-employment tax, which is Social Security and Medicare on self-employed earnings, is 15.3% on net profit before the income tax layer on top. For someone who made $6,000 doing odd jobs and paid nothing quarterly and didn't report it, the bill when it catches up is not trivial, and the penalties and interest that accumulate on unreported self-employment income can add meaningfully to the original liability. The fourth situation is the one with the most moving parts and the most potential for a genuinely expensive mistake: selling things at a profit. And before you say that doesn't apply to you, let me describe the situation more precisely, because it comes up far more often than people realize. You buy things specifically to resell them. Maybe you buy items at estate sales or thrift stores and flip them online. Maybe you buy limited sneakers or collectibles and sell them when the value rises. Maybe you buy wholesale and sell individually. Maybe you got into the habit of buying things you thought you might use and reselling them when you didn't. If you are buying things with the intention of reselling them at a gain, that is not selling personal items at a loss. That is a business activity, or at minimum, a capital gain, and the profit is taxable. The challenge is that the line between casual personal selling and a resale activity is not always obvious. And the IRS uses a set of factors to determine which side of the line you're on. How frequently do you do it? Is there a profit motive? Are you buying things specifically to resell rather than for personal use? How much time do you spend on it? What's the scale of the activity? None of those factors is individually determinative. But if you've been moving significant volume through eBay, Mercari, Depop, or any other resale platform and collecting payment through PayPal or Venmo, and you've been treating it mentally as just selling stuff rather than as a business or investment activity, the 1099K arriving with a number that doesn't match anything on your return is the beginning of a conversation with the IRS you'd rather have been prepared for. Let me give you a name. I'll call him Marcus. 34 years old, works in it, lives in Phoenix. Started buying and reselling sneakers a few years back as a hobby that grew into a fairly consistent side activity. He'd buy pairs online, sell them through StockX or Goat, collect payment through PayPal, and genuinely hadn't connected this to a tax obligation because it never felt like a real business. It was just buying and selling things he was interested in. Over the course of one calendar year, his PayPal received roughly $23,000 in payments from those sales. He received a 1099K, filed his taxes using a basic software product, didn't know how to handle the 1099K, left it off, got a notice from the IRS the following year. The notice didn't know he'd also paid $18,000 to acquire the inventory he'd sold. It just saw $23,000 in received payments with no corresponding income or explanation. The IRS proposed additional tax based on the full $23,000 as income. Marcus had to go back, reconstruct his purchase records from memory and bank statements, and file an amended return showing the actual profit after cost of goods. The amended return showed a taxable profit of around $4,200, on which he owed tax. The actual tax on that amount was manageable. The penalty for underreporting the interest that had accumulated while the notice sat, and the cost of getting help to sort it out, added significantly to the total. The original obligation wasn't the problem. The not knowing it existed, and the not knowing how to document it, was the problem. What Marcus needed, and didn't have, was a basic system. A spreadsheet, a folder, any organized method of recording what he paid for each item and what he sold it for, kept at the time of the transaction, rather than reconstructed a year later under pressure. The cost basis records would have made the amended return straightforward. Without them, it was a stressful, expensive, months-long process that shouldn't have been any of those things. Now let me talk about the IRS matching process, because understanding how it works tells you exactly why the accounting piece matters so much. The IRS runs what's called a document matching program. When you file your tax return, their system automatically compares the income you reported to the income documents they received from third parties: W-2 South, 1099 INECs, 1099 INTs, 1099 DIVs, and now 1099 kilosecond. If a document was issued with your Social Security number on it and the corresponding income doesn't appear on your return, the system flags it. This is largely automated. It doesn't require an auditor to notice something suspicious. The computer does the matching, finds the discrepancy, and generates a CP 2000 notice, which is the IRS's way of saying, we received information that suggests your return may be understated, and we're proposing additional tax. The CP 2000 is not an audit. It is not a criminal matter. It is a computer-generated discrepancy notice, and it is extremely common. The IRS sends millions of them every year. For many people, it's the first time they've ever received any contact from the IRS at all, and the reaction is often disproportionate panic. The good news is that ACP 2000 for a 1099-K that represented non-taxable transactions is resolvable. You respond to the notice with documentation showing why the income on the 1099-K was not taxable or not fully taxable. Original purchase receipts showing cost basis, records showing the transactions were personal reimbursements, documentation showing the sales were at a loss. The response process is specific, and there are deadlines attached to it, which I'll come back to. But the underlying situation is fixable if you have the documentation and respond correctly. The expensive version of this story is the person who receives the CP 2000, panics, doesn't understand it, misses the response deadline, and gets assessed the full amount proposed by the IRS because no response was received. Or the person who responds but doesn't know how to document non-taxable transactions correctly, and the IRS doesn't accept the response. Or the person who ignores it entirely because they're not sure what to do, and the proposed assessment becomes a final assessment with a collection process attached. The IRS is actually quite reasonable when engaged with directly, proactively, and with documentation. It becomes significantly less reasonable when ignored. So here is what you actually do, specific and actionable for each situation. If you use payment apps for personal transactions, reimbursements, and splitting shared expenses, do these things now. Go into Venmo, Cash App, and PayPal and make sure every personal transaction is tagged as personal rather than goods and services. Turn off or adjust any settings that allow the platform to categorize your transactions ambiguously. Keep a simple note, even a text document on your phone, that records large or unusual personal receipts with a one-line description. If a friend pays you $800 because you covered their share of a rental car for a trip, note the date, the amount, and the fact that it was a reimbursement. This takes 30 seconds at the time, and it's the difference between answering AIR's notice in 20 minutes and spending 3 hours trying to remember what a payment from 2 years ago was for. If you sell personal items secondhand, keep the purchase receipt for anything you sell for a meaningful amount. A receipt, a credit card statement, an order confirmation, email, anything that shows what you originally paid. When you sell the item, note the sale price. If you sold it for less than you paid, the transaction is non-taxable, but still needs to be reconciled on your return. If a 1099-K arrives, the reconciliation is simple when you have the numbers. Without the numbers, it is a guess, and guesses don't hold up well when the IRS asks questions. If you do any kind of casual freelancing or side work, you need to be treating it as self-employment income from the first dollar. Report it on Schedule C of your federal return. Deduct legitimate business expenses, which are expenses incurred wholly and directly for the work. If you drive to clients, track the mileage. If you buy supplies specifically for the work, keep the receipts. If you use a portion of your home exclusively and regularly for the business, the home office deduction may apply. These deductions reduce your net profit, which is what you actually owe self-employment tax on. Someone who made $8,000 in gross freelance income and had $3,000 in legitimate expenses owes self-employment tax on $5,000, not $8,000. The difference is real money, and the only way to capture it is to keep the records at the time the expense happens. If you resell items for profit, you are running a business, or at minimum, engaging in a capital gains activity, and the record-keeping requirement is non-negotiable. For every item you buy to resell, record the date, the amount paid, and any directly related costs, like shipping or fees. For every item you sell, record the date, the sale price, and the platform fees deducted. The difference between the two is your taxable gain. Keep these records in real time, not reconstructed after the fact. A spreadsheet is fine, a dedicated notebook is fine, any system that you actually use and keep current is fine. The IRS does not care what format your records are in. They care that the numbers are there and supportable when asked. If you receive a CP 2000 notice, do not ignore it. The notice will have a response deadline on it, typically 60 days from the date of the notice. Read it carefully. It will tell you exactly what income the IRS believes was underreported and what additional tax they're proposing. Respond in writing before the deadline. If the income was non-taxable, send documentation showing why. If you owed some but not all of what they're proposing, explain the difference and show the records. If you're not sure how to respond, that is the moment to get professional help. A tax professional dealing with ACP 2000 response is a limited, focused engagement, not a comprehensive audit representation. It is manageable, and it is far better than missing the deadline and having the proposed assessment become final. Now, let me come back to something I said at the beginning that I want to make sure lands properly, because it's the thing I most want you to walk away understanding. The existence of the 1099-K does not create a tax bill. The existence of unreported or incorrectly handled income creates a tax bill. For a very large number of the people who are now inside this system, the 1099-K represents transactions that are entirely non-taxable: personal reimbursements, sales at a loss, gifts, shared expenses. The tax code has not changed on any of those. What has changed is that the IRS now has visibility into the payment volume and is waiting to see how it appears on your return. The answer for most people, when the accounting is done correctly, is that the amount owed is zero or very small. But that answer has to appear on the return in a form the IRS can see and match. An accurate return that reconciles the 1099-K correctly is a boring document to the IRS. An unreconciled 1099-K is a flag. The whole thing comes down to the same principle that runs through every tax situation that involves third-party reporting. The IRS already has the data. They received it from the platform directly. The question is never whether they know the payment happened. The question is whether your return tells them a complete and accurate story about what the payment was. Clean story, matching numbers, documentation on file, that is the most boring thing in the world to a tax examiner. That is the goal. Being boring in this context is exactly right. I'll leave you with a person. I'll call her Sandra. 51 years old, office manager, not a business owner, not a freelancer. Just someone who spent a year clearing out her house after her kids left home. Sold furniture, old electronics, boxes of clothes, sports equipment the kids hadn't touched in a decade. All through Facebook Marketplace and eBay, payments through Venmo and PayPal. Total receipts across both platforms for the year came to just over $7,000. She received 2 1099-Ks. She'd never received one before. She had no idea what to do with them. She came to a volunteer tax assistant site in her area, sat down with a preparer, and spent about 40 minutes going through the sales. For every item she could document the original purchase price for, which was most of them because she'd kept her email order histories, the sale was clearly at a loss. Couch bought for $1,200, sold for $180. Laptop bought for $900, sold for $120. Treadmill bought for $600, sold for $75. Not a single taxable gain in the lot. The preparer reconciled both 1099Ks on the return, showed the cost basis for each category of items, reported the sales, showed the losses, and the taxable income from the entire $7,000 was zero. The return went in. No notice followed. Sandra paid nothing additional because she owed nothing additional. But if she had filed her return the same way she'd filed it every year before, without addressing the 1099Ks, the IRS's matching system would have flagged $7,000 in unreported income and sent her a notice proposing tax on the full amount, and she would not have known immediately how to respond to it. The forms are arriving. The data is already there. The only variable is whether your return tells the complete story. For most people, that story ends in zero additional tax. But zero additional tax doesn't happen automatically. It happens because you account for what arrived, show the documentation that explains it, and give the IRS the full picture. The full picture is almost always on your side. It just has to be the picture your return actually shows. That's the whole thing. The IRS is watching the apps. They've been watching longer than most people realize. The answer is not to panic, and it's not to ignore it. It's to understand what the watching means, keep the records that explain what the money was, and file a return that makes the explanation visible. Simple, clean, and documented. That's it. That's the whole job. If this was useful, share it with someone who uses Venmo or Cash App without thinking much about it, which, at this point, is most of America. The people who understand what a 1099K is and how to handle it are going to be fine. The people who don't are going to get letters they didn't expect. For money they may not actually owe and spend a stressful amount of time sorting something out that 15 minutes of understanding now would have prevented entirely. Go check your app settings. Keep your receipts. File the full story.